First off, thank you very much for your participation this evening. We have what I think is going to be an interesting session because we're going to use all the information that we've put together from our prior classes and frame this from the perspective of auditing business processes. Okay, so auditing business processes sort of applies all this other stuff, and it's the case in auditing, and at least teaching auditing, that is somewhat frustrating, although I don't have a better idea for this. But the problem is that you have to learn all these abstract ideas until you begin to apply it. And it's not until the middle of the semester that we're actually able to apply these items. So now we are applying these items, and in the next 3 chapters we're going to talk about some very specific issues related to the audit process as they relate to specific business processes. So that's the goal of what we have. So let's go ahead and jump into the material. Once we're done, I will open it up for questions in terms of some other issues if you have any other questions. But I want to use this hour. We got 3 chapters to really go through some really hardcore information related to auditing. So the first thing that we're talking about relates to cash and financial investments. One of the things that we need to understand as it relates to cash is internal controls. We need to understand how this relates to the audit process. One of the issues that we are concerned with is cash coming in actually is a part of the revenue cycle. Cash going out is actually a part of the process of the purchasing process. But what we're focusing on now is cash. Cash has some very unique characteristics that makes it susceptible to fraud and to other issues. So we want to talk about cash from the perspective of what it is, the inherent risk related to cash. So when we talk about cash, let's talk about specifically what we're talking about. So we're talking about receiving checks. We're talking about issuing payroll checks. We have this whole issue of petty cash. Petty cash is an interesting concept because many times within an organization there needs to be a pool of cash to conduct day-to-day business. This is what we call petty cash, and there needs to be some very specific controls related to this. Savings accounts, and actually the whole concept of managing all of the individual bank accounts becomes highly problematic for an institution or an organization, because just by the business's very nature, it's very difficult to manage from one individual account. There needs to be many accounts, and with these many accounts there's various layers of complexity and risks. When we talk about cash, we need to think about cash from the perspective of what is cash. Well, cash obviously is cash, but from a cash equivalent perspective, we are considering things such as money market funds, certificates of deposits, or savings certificate. The idea is that all of these have a very short maturity date. So the idea is that these items can be converted to cash in a very instantaneous basis. The objective for auditing cash, number one, is we need to understand the client and its environment to consider inherent risk, including fraud risk related to cash. Critical to the organization. Some organizations are dealing with online transactions. Most of the transactions are coming through as credit card transactions. That has its own types of risk. But many organizations are dealing with a tremendous amount of cash, real hard cash, the fungal, there's an issue related to cash which is fungibility, meaning that it's easily transferable. And if I have a dollar bill, it's sort of that old adage of finders keepers, losers weepers, is if that's your dollar bill, but I have possession of it, it's very difficult for you to prove that in fact that is your dollar bill. So there is a specific inherent risk related to cash. Not only is it fungible, but it's also very desirable. I want cash and if I take your cash, I'm happy, you're clearly not going to be so happy. That's why we need to understand internal controls, but we clearly need to understand the internal controls from the framework of the type of organization. So as an example, if we're dealing with a retail store or a restaurant that deals with a lot of cash and you have cash drawers, then there's going to be some very specific controls associated with this. So the first thing that we do is we understand the inherent risk. Now the next, you notice item 3 is assess the risk of material misstatement of cash and design tests of controls and substantive procedures. So the idea is as we address the inherent risk and the control risk, and the control risk is basically what management has implemented for internal controls over cash, then we assess the risk of material misstatement. From here, we're able to design tests of controls. This is especially important if we are doing a integrated audit as required by Sarbanes-Oxley, as well as substantive procedures. And again, our substantive procedures are where we are measuring monetary misstatement. So what we want to do is, and you notice that these items that are in bold and italicized are in fact management assertions. So we want to substantiate the existence of recorded cash and occurrence of related transactions, establish the completeness of recorded cash, verify cutoff and accuracy of cash transactions, determine that the client has the rights to the recorded cash, determine that the presentation and disclosure of cash, including restricted funds, is appropriate. Let me go to the list here, and okay, so everybody is on mute, so that's good. Okay, so again, you just kind of look through this and you see very specific assertions as they relate to cash. As we continue on here, what we're interested in is when are we actually going to audit. So if you remember, once we determine the risk of material misstatement, we determine the nature, timing, and extent of our substantive procedures. So one of the issues is time, so timing. So the audit time for cash. Cash typically has small account balances, but auditors devote a large portion of the total audit hours because liabilities, revenue, and expenses flow through cash. Most liquid assets most are liquid assets, so are a great temptation for misappropriation. And as we've talked about, is the inherent risk related to cash is high, so there is a high inherent risk associated with this. Finance and accounting departments work together to provide assurances that all cash should have been received was in fact received, recorded accurately, and deposited. Cash disbursements have been made for only authorized purposes and have been properly recorded. Cash balances are maintained at adequate but not excessive levels of forecasting. When we look at internal controls, we want to think about things in terms of segregation of duties as well as record keeping and some other issues. So we should not permit any one employee to handle a transaction from the beginning to end. So as an example, if we have cash drawers, and essentially what we're talking about here is in a retail situation, if you notice, if you go to a grocery store, that the individuals that are running the cash register have a cash drawer. So they actually take that cash drawer out when they leave, and the new person comes in with their own cash drawer. Well, what are they doing? They're taking that cash drawer to the back and together with someone else counting the money and comparing it to the actual receipts for the cash. It becomes also clearly apparent that as we take cash out to deposit it, we need to understand that there needs to remain a level of cash. The cash audits that I've done in retail stores, generally speaking, they expect to see $250 or $300 of cash in various denominations and so forth in the cash drawer. So when they're counting the cash, they basically consider the cash drawer as the bank, and anything in excess of the base becomes the amount that they're going to deposit, and this is then compared to the amount that is recorded on for the various transactions. Okay, so that's the process that we go through in terms of recording this. The key point that we need to understand is the fact that this person is not doing this him or herself. There is a reviewer. That reviewer signs off every step of the way. It then gets put in a sealed plastic bag. That's signed off, put into a safe, and then at the end of the day, the various bags from the safe are then collected, signed off, and turned over to a some sort of security guard or whatever, and then that money then gets transferred to the bank. There needs to be separate cash handling for record keeping, centralized receiving of cash to the extent possible. When we talk about cash here, we're also talking about checks. So the idea is that as checks get mailed in, we want to make sure that they're received at a specific point. And in fact, one of the things that many organizations use is some sort of deposit repository where checks are sent directly to a bank. The banks collect the cash, create the reconciliation, and the cash goes directly into the bank, and then the organization then has a specific record of this cash. We record cash receipts on a timely basis. We clearly do not want to have things lag for several days, and in fact, the process that I described for the cash drawer, generally speaking, is done multiple times during the day. And the reason that we want to do this on multiple times is that if there is a mistake, we need to isolate that to a very specific period of time so that we can then go back and review additional information. So there may be a recording of a visual recording of the transactions, and if we understand the timestamp of the transactions, it's much easier to go back and actually see what actually has taken place. We encourage customers to obtain receipts and observe cash register totals. I'm sure you've gone to various stores. I think I usually see this in airports. The sign says, if you're not offered a receipt, your purchase is free. Okay, so why are they doing this? Well, what they're doing is they are forcing the cashier to actually complete the transaction. The worst thing in the world you want to have happen is it's a $10 item. The customer gives the $10 to the cashier, and what happens is that $10 never actually ends up in the cash drawer. So we need to understand that getting customers to participate in these internal controls to obtain the receipt is actually a very good thing. So when you see that sign that says, if you're not offered a receipt, your meal is free or your purchase is free, the reason that is there is as an internal control. You are now part of the internal control process to assure that the person is actually doing this correctly. Deposit cash receipts daily, absolutely critical. This is usually done at the end of the day. And again, as these cash transactions are completed, put in these bags, put in the safe, at the end of the day, everything is signed off, given to the security guard, and the security guard is then the one that takes it to the bank or to the next process. This is a daily basis. The longer you wait, the harder it is to determine where the risks are, if in fact there are problems. And we say cash receipts daily. It's very possible that you may be doing this more than once a day. Make all disbursements by check or electronic fund transfer with the exception of small expenditures from petty cash. Petty cash gives you the opportunity to complete transactions in cash as opposed to check. So as an example, if you are if you do a lot of little travel from the office that's based upon the business, you're getting cash receipts from taxi cabs and so forth, is turning these in and converting these to cash through the petty cash drawer is a much more efficient process as opposed to generating a check. So there is a place for petty cash, but petty cash absolutely then creates an additional risk associated with cash. Have monthly bank reconciliations prepared by employees not responsible for the issuance of the check or the custodial of the cash. The completed reconciliation should be reviewed, notice the word, promptly by an appropriate official. The last thing in the world you want to have happen is you come to the audit, to start the audit, and you find out that yes, the bank reconciliations were done, but the bank reconciliations for the past 10 or 11 months were done not immediately after the month, but were done last week. Reconciliations is a tremendous internal control, but it's only an internal control if you reconcile immediately. Monitor cash receipts and disbursements by comparing the recorded amounts to forecasted amount. That what we're describing here in 9 is an example of an analytical procedure. Cash sales involve 2 or more employees. We've actually talked about this in terms of cash registers and how the additional person is there to review. And again, the additional person is there to review, sign off, to put it in the safe, and then all of those bags of money are signed off and given to someone else. So every step of the way there's sign-offs, and you're able to, through these sign-offs, able to determine where the issues are. Electronic point of sale systems becomes very important because this then gives you a starting point for the reconciliation of cash. Collection of receivables, initial listing of cash receipts. So the idea is that as checks come in, what we want to do is we want to have an independent person write these checks down and the amounts. And at the end of the day, what we're going to do is we're going to compare how many checks that we have posted as compared to how many checks were in this initial listing. Custodial and deposit of cash receipts, I think we've talked about that. Maintenance of accounting records. Clearly, we don't want to have the person in charge of cash recording changes to accounts receivables. Reconciliation of cash ledgers with control accounts. Mailing monthly statements to customers. The mailing of the monthly statements to customers should be done by specific people that do not have a vested interest in hiding transactions. So as an example, it would not be appropriate for sales to be sending out these monthly statements. It also would not be appropriate for accounts receivable to be mailing monthly statements because these need to be done externally. And as we're talking about monthly statements to customers, is the complaints related to account balances should not go to accounts receivable. They should go to someone else. Because what may happen is, let's say accounts receivable is in fact perpetrating some sort of fraud. Well, if you stole my money, if you're the accounts receivable clerk, you stole my money, I call and I say, listen, I paid this check, I paid this bill, here's my canceled check. Why am I still receiving a bill? If you were the one that was perpetrating the fraud in accounts receivable, you simply would say, don't worry about it, I'll fix it, set up a credit memorandum, and end of problem. Well, we don't want to have that happen. If those complaints go outside, then someone is able to investigate exactly what's taking place. Collection activities and past due accounts. As we are examining our past due accounts, this in fact may give us direction in terms of what is actually taking place within the organization. A flow chart here, I'm really not wanting to go through this, but this is an example of gaining an understanding of the control process. And based upon this understanding, we're going to determine where in fact we will be doing our test of controls. So let's talk about internal controls. Again, most of the stuff we've talked about, segregation of duties, clearly payment by check or electronic transfer. Pre-numbered checks, absolutely critical. If we are using some electronic software such as ACL, we're actually able to go through the checks and look for missing numbers, which becomes a very good and interesting audit tool. Matching purchase orders and receiving documents with vendor invoice. We'll actually talk about this as we are going through the purchasing cycle, but essentially what we have here is a description of the process of what we call a three-way match. And the three-way match is critical in terms of our cash disbursements. Reviewing supporting document by authorized check signers as part of our internal controls. We are definitely going to be looking at signed checks and supporting documentation to make sure everything is approved appropriately. Canceling supporting documents. If we have invoices, we absolutely want to make sure that we are not paying the invoice twice. The way that we prevent this from happening is by canceling the supporting documentation so that we do not pay that invoice twice. Authorized check signers should be mailing the checks. So one of the things that becomes very interesting in the accounts payable cycle is we've talked about this three-way match. Accounts payable is matching the invoice to the receiving document based upon the number that was received, and the purchase order based upon the items, the quantity, and the pricing that was established up front. If it matches, accounts payable is not paying the invoice. What accounts payable is doing is approving the payment. Well, the payment then is generated through the Treasury Department, and they're the ones that are actually sending the check. So we need to have that line of demarcation between approval and actually generating the transactions. Monthly bank reconciliations, we've talked about that. Okay, so another control process, and you notice that this is voucher payable. So this is the accounts payable cycle. And again, we're going to talk about this a little bit more when we talk about the purchasing process. An audit of cash. We use the understanding of the client and its environment to consider inherent risk, including fraud risk related to cash. Obtain an understanding of internal controls over cash, assess the risk of material misstatement, and design further audit procedures. It's very standard in terms of what we're trying to do: gain an understanding, obtain understanding of internal controls, and then develop these specific audit procedures. Some examples of tests of controls is to test the accounting records and reconciliation by reperformance. Compare a detail of sample of cash receipts listed to the cash journal. Compare the detail of sample of recorded distributions to accounts payable, purchase orders, receiving reports, invoice, and paycheck. So C is where we are actually auditing the purchasing cycle. So in the purchasing cycle, we see what we paid. We want to make sure that it was paid based upon a valid invoice. We want to make sure that that valid invoice was compared to receiving and was compared to purchasing, and that this was a legitimate purchase. We want to make sure that we didn't pay it twice, so we're looking for duplicate payments. And again, what we're looking for is the complete process. If necessary, revise the material misstatement based upon the results of the test of controls. Substantive procedures, confirm account balances with financial institutions. When you see the word confirmation or confirm, what we're talking about here is getting information from outside. So confirming account balances with financial institutions means that we go directly to the institution and request a confirmation of account balances. They'll give it to us, actually, generally speaking, charge for the service. But once we have that, That then becomes the basis for our reconciliation. But again, keyword is confirm, and when you see the word confirm, we are going to outside. Obtain or prepare a reconciliation of bank accounts as of the balance sheet date and consider the need to reconcile bank account activity for additional months. The reason we want to look at additional months is to look at this issue related to what we call kiting. I think we actually do have a couple of slides related to this, and this essentially is where there are various checks floating out there deposited into the same account, and you're not going to see that at a year-end transaction or a year-end bank reconciliation, but you will see that in subsequent periods. Count and list cash on hand. The one point that I want to make related to 5, counting and listing cash on hand, is when we do a physical count of cash, make sure that you are not alone. Make sure that someone from the client is actually there. And the reason this is absolutely critical is if you go in there and you count cash on your own and it's missing, guess what? They're going to say, well, you took the cash. This actually occurred in an audit that I was not directly involved with, but one of my one of the people that I work with was, she wasn't counting cash, but she was counting some sort of fungible item. It was bus passes. And it's a long story, but basically the organization provided bus passes, each of them worth $2 or $3 to clients so that they can go back. So there's a stack of 1,000 or so of these, and the 1,000 or so, again, worth some substantial bucks when you consider the amount per ticket. She went in, she counted them. It was obvious that someone had stolen some items, or they were missing, or something. She reported this, and because she did not have someone with her when the count took place, someone from the client, she was actually blamed for the missing items. So be very, very careful when you do physical counts of anything like cash or investment certificates or anything like this that could be stolen. Is make sure that you protect yourself, because if something's missing and you identify this, if nobody's there to validate the fact that it's missing, you're going to get blamed for it. Verify client cash cutoff of cash receipts and cash disbursement. Very important for year-end balances. We want to make sure that cash on hand is as of December 31st. And cash disbursements is, again, as of December 31st. Bank transfers for the last week of the audit and the first week of the following year. Again, this whole issue related to kiting. Investigate any checks representing large or unusual payments to related parties. And evaluate proper financial statement presentation and disclosure. When we see substantive procedures, we're talking about procedures where we are measuring monetary misstatement. When we're measuring monetary misstatement, we are looking for errors, and this then becomes the basis for our opinion. Some substantive procedures is obtain an analysis of cash balances and reconcile them to the general ledger. Confirm cash balances with financial institutions, obtain reconciliation of bank balances, and consider reconciling bank activity, obtain bank cutoff statements, count, verify client cutoff procedures, and so forth. So you see here that as we are doing these things, we are looking for misstatements. So substantive procedures are not to identify internal controls, they are to measure monetary misstatement. Examples of fraud with cash. Do the client's records reflect all cash transactions that took place in the year? Were all cash payments properly authorized? Related to fraud is the interception of cash receipts before any record is made payment for material not received, duplicate payments. And I will tell you that duplicate payments sometimes is a common problem, not necessarily fraud, but more related to management incompetency. Overpayment to employees or to fictitious employees, payments for personal expenditures of officers or related parties. This last item, this is one of the reasons that we always audit the executive travel and entertainment expenses. We want to make sure that as we're spending this money, that we're actually paying for services that relate to the organization. Okay, since I think we get an idea of what we're trying to cover here, let's go to the next chapter. The next chapter is chapter 11, and chapter 11 is really sort of the same thing, is we're talking about accounts receivable and revenue. Why is this important, and why does this actually relate to cash? Well, we are auditing a process. This process, in this case, we're looking at the revenue cycle. So the first transaction related to the revenue cycle is the point of sale. Point of sale is we have a debit to accounts receivable, a credit to revenue, or debit to cash. But if it's accounts receivable, the ending point of the revenue cycle is when we actually get paid. So cash collection then becomes a part of this revenue cycle that we're describing. Sources of accounts receivable, claims against customers from the sale of goods, loans to officers or employees, loans to subsidiaries. Keep in mind that when we have loans to subsidiaries, we are talking about related party transactions, claims against various other refunds, claims for tax refunds. These are shown on the balance sheet at net realizable value. Well, what do we mean by this? Well, keep in mind that our accounts receivable is net accounts receivable, so it's what is owed to us minus the allowance for doubtful account. So this is the net accounts receivable and relates to the net realizable value. One of the things that we as auditors will be doing is taking a close look at that allowance for doubtful account to make sure that we are actually allocating or measuring that appropriately. Notes receivable, written promises to pay certain amounts at future dates. Notes for substantial amounts, installment notes or contracts can allow the seller to hold a lien on the goods. Examples include the sale of industrial machinery, farm equipment, issuance of capital stock, and again, loans to officers. So when we look at this, what we want to consider is audit risk. So when we talk about audit risk, what we are talking about is the risk that the auditor is issuing an unqualified opinion when in fact there are material misstatements. Audit risk is significant because many incidences of fraud have been involved in terms of overstating of receivables and revenue. So there's a high fraud risk. Revenue recognition may be based on complex accounting rules, and receivables and revenues are usually subject to valuation using significant accounting estimates and significant management decisions related to these values. The objectives for our accounts receivable and revenue is, first is understand the client and its environment to consider inherent risk. And again, keep in mind that if this is a cash business, accounts receivable is not that big of a deal. We have other issues, but if it's a cash business, accounts receivable is not the problem. If it is a business where we're relying on credit card sales, we generally speaking differentiate credit card receivables, which usually get paid in a day or so, as compared to our accounts receivable from customers. So the only way that we understand where the risks are is if we understand the client related to revenue and receivables. And again, we clearly have a high risk threshold or a high risk issue here because of the fact that these are areas where if you wanted to perpetrate fraud, this is where you would want to do this. So once we understand the inherent risk, we then understand the control risk. So what we want to do is we want to understand the controls and the internal controls over receivables and revenue. And as we talk through this, it's very important that, again, that through our understanding and our documentation of the process is that we determine very specific procedures to test our internal controls. And again, once we have our internal controls, which is the risk of the control risk and our inherent risk, we have the risk of material misstatement. From here, we're going to design a test of controls and substantive procedures. And again, we're using this test of controls based upon the Sarbanes-Oxley 404 testing, and substantive procedures is where we are measuring monetary misstatement. So you notice here that we are looking at substantive procedures where we are considering the management assertions: existence, occurrence, completeness, cutoff, accuracy, presentation, and disclosures and rights. Internal controls, very important because of the risk of intentional misstatement. Companies like to overstate their revenue because it looks good. The problem with this is that overstated revenue represents receivables that never get paid. We don't like that. So what we're looking for is how we actually manage this from a control perspective. Clearly, we need to have an ethical framework from the organization, commitment to integrity, independence of the board and the audit committee, the appropriate structure and lines of responsibility, commitment to recruitment, development, and retaining competent employees. Back to the issue that we've talked about several times is having a strong human resource department, holding employees accountable. In our risk assessment, what we want to look at is risks related to revenue. We clearly want to have a division of duties. Segregation of duties is absolutely critical in this area. The segregation of duties is between the sales order and the approval of the credit. Generally speaking, we look at sales from the sales personnel's perspective. We want to make sure that they are not approving credit. The credit is approved from an objective perspective, and we only want to have customers that actually are going to pay their bills. So the credit approval process and the acceptance of this customer as a valid customer is separated from the salesperson. Issuance of merchandise from stock. We clearly don't want to have the salesperson issuing merchandise from stock. That has to be done separately, as well as shipping. Billing, we basically have talked about that in terms of billing customers. This clearly needs to be separated from other functions such as accounts receivable management and so forth. And again, the reason we want to do this is we do not want one person to control several steps of the process to perpetrate some sort of fraud. Maintaining control ledgers, approval of sales returns and allowances. If sales returns and allowances is yet another means of perpetrating fraud, and we need to understand how the controls are there. The authorization of the write-off of uncollectible accounts should only be done from the Treasury Department, not from the Financing Department. So when we think about the cycle, we think about the purchase order, sales order, basically the same thing. Bill of lading is when we actually ship the document. The invoice is when we bill the customer. Control listing essentially tells us where we are in the process. Credit memo is if for some reason we essentially credit the customer's balance. For whatever reason, they returned the merchandise or they were dissatisfied or whatever the reason is, this is the credit memo. clearly the accounts receivable department should not have the authority to create a credit memo. This essentially is a documentation of the receiving and the purchasing cycle. When you look at the documentation, and this is, we're documenting this based upon a flow chart, is what we're trying to identify is a segregation of duties and where the internal controls are or should be, so that we can then use this template as a framework for developing our control structure. So this actually is a very interesting table. This comes directly from your book. We have a control activity, the type of control, and as it relates to management assertions. So just very briefly, as an example, the first item we're looking at here is a segregation of duties over sales and collection of receivables. Observation and inquiry then becomes a part of our testing to make sure that the segregation of duties is appropriate. Internal controls over revenue, segregation of duties between sales and collecting, matching sales invoices to shipping documents. Clearly, we should only be shipping if we have a valid sales invoice for a valid customer that has been approved as through the credit process. So by matching the sales invoices and comparing these to shipping documents, two things we're going to find out. We're going to find out, well, maybe we sold something, but for whatever reason we didn't ship it. Well, if it's back ordered, that's one thing, but the worst thing you want to have happen is it's back ordered, you don't ship it, obviously, because it's back ordered, but then the product comes in and then you forget to fill this back order. So we want to look at this and sort of do a match, sales invoices to shipping documents, and from this comparison, look and see what items actually have not matched. Again, becomes very interesting and easy to do as we are looking at this from our electronic software. Clerical accuracy, that's a given, and credit approval, we've basically talked about that. Mailing monthly statements, the mailing of monthly statements, as we talked about before, should be done separately from accounts receivable and sales. We want to make sure that when we mail something, it's done based upon what's owed, not based upon the fact that, well, we don't want to mail this because it looks like they owe money, but they don't really owe money because we took their money. Okay, so we don't want that to happen. Revenue cycle controls, continuing, reconciliation of bank statements, use of control listing related to cash receipts. And the point that I want to make here as we are looking at this is you notice how we talked about cash in the last chapter. Now we're talking about the revenue cycle, and in the revenue cycle, understanding cash becomes a critical element of the process. But again, we also want to understand shipping, billing, credit, and these other issues. Notes receivables, want to look at the subdivision of duties, custodial, acceptance, renewal, write-offs, and so forth. Audit documentation is some of the things that we're going to look at. As an example, if you look at the aged trial balance of accounts receivable, this becomes a process, or this becomes a document whereby we're able to test the reasonableness of the allowance for doubtful account based upon an assessment of how old these accounts are in the accounts receivable cycle. Audit steps: understand the client, understand the internal controls, assess the risk of material misstatement. These further audit tests include things like examine a significant aspect of a sample of sales transactions, compare a sample of shipping documents to related sales invoices, and again, what I would do is I would look at what was shipped, what was sold, and what was billed. So we have three separate files. I would do a match on them, and I would then identify where the items don't match, whether on quantity, price, or maybe the item was sold but it wasn't shipped, or maybe it was shipped and it wasn't sold, or I think you get the idea. So testing this from an exception perspective becomes very interesting. Reconcile selected cash register receipts and sales tickets with sales journals. You notice how this really dovetails with our discussion related to cash. Test the IT application controls. We absolutely want to understand the level of role-based controls in the IT system. Role-based controls, as an example, the person that creates an account needs to be identified, and this person should not be accounts receivable. It might be accounts receivable, it would be somewhere in accounting. It probably would not be accounts receivable. It clearly would not be the sales department. So it would probably be the person that is approving the credit for this organization or for this customer. So how we input a new customer into the system and who has access to that, as an example, would be some of the IT application controls that we are considering. Further audit procedures in terms of substantive procedures is, we've talked about this, obtaining the aged balance of trade accounts, obtain analysis of notes receivable, confirm accounts receivable. Confirmation, we've talked about, is a substantive procedure. In confirmation, we are going out to the customer and requesting that they validate what the balance is. Okay, so what we have here is we have the substantive procedure. Again, we are using substantive procedures to measure monetary misstatement. And you notice here that we are, as an example, the last item is evaluate financial statement presentation and disclosure. This is a table that's coming directly from the book, and what we see here is we have a description of the misstatement, examples of this, and the internal controls that should be in place. So as an example, recording unearned revenue. Well, examples of this are fraud is we're recording fictitious sales without receiving a customer order, or intentional over-shipping of goods. And errors is recording the sales based upon a receipt order from customer rather than the shipment of goods. So you see a couple of items here that sort of become interesting. Okay, the internal controls is ineffective oversight, the tone at the top, but we're also wanting to identify who has the authorization to ship, making sure that there is a line of demarcation between the shipping department and the sales department. And so as you're going through this is, again, what we're looking for is we're determining if in fact the internal controls are in place. Okay, let's in the final few minutes talk about the last chapter. The last chapter is chapter 12, and we're looking at inventories and cost of goods sold. So as we're looking at this section, as we're looking at chapter 12 on inventories and cost of goods sold, keep in mind that this is the purchasing process of what it is that we're trying to do. Purchasing as well as accounts receivable, or excuse me, as well as inventory. And again, think about inventory is the asset. As it's sold, it then becomes cost of goods sold. Inventory is complex in a manufacturing environment because you're using some sort of absorption costing system. In this absorption costing system, what basically is taking place is costs coming from personnel, materials, and so forth, and gets absorbed into the work in process and finished goods. And again, it's not until it's sold does it become an expense. So valuation becomes very important. Misstatements of inventory directly affects the cost of goods sold and therefore income. Management of fraud has often involved fraudulent overstatement of inventories. Sources of inventory: goods on hand ready to sell, goods in the process of production, goods to be consumed directly or indirectly, such as raw materials, purchased parts, and supplies. So in a manufacturing environment, I'm sure you've taken cost accounting, is you have those three line items in your balance sheet related to inventory, and you have raw materials or supplies, you have work in process, and then you have finished goods. So understanding how costs flow to work in process and finished goods becomes critical to our understanding of the process. We need to understand the client and its environment, understand internal controls, assess the risk of material misstatement to determine the test of controls and substantive procedures. As we see here, we are doing these substantive procedures based upon the management assertions that we have talked about in earlier cases. Okay, here's just an interesting fraud case from McKesson and Robbins. Significant impact on the responsibility of auditors with respect to the validity of inventory. The audited financial statements contained $19 million worth of fictitious assets, including $10 million of non-existent inventories. Auditors followed customary practice, which limited audit work on inventory to examining records only. The Statement on Auditing Procedures 1 and 2, first formal auditing standards issued by AICPA, affirmed the importance of auditor observation of physical inventory, although the other auditing procedures could be substituted. So the idea is that one of the things that we do as auditors is we observe the physical inventory count of inventory. That observation of the physical inventory count is considered a substantive procedure where we are looking for monetary misstatement. I think we understand the difference between a periodic inventory versus perpetual inventory. The problem with the periodic inventory is when we move a certain amount of cost over to cost of goods sold, we don't know if that cost was related to sales or if the items were stolen. So periodic inventory has a very low level of control for the organization. When we're looking at our perpetual inventory, especially if you combine a perpetual inventory system with the a periodic inventory count, is when we talk periodic inventory counts, a lot of organizations will count maybe not every piece of inventory every night, but we'll go through the organization on a routine basis so that this shelf is counted tonight, the next shelf is counted the next night, and so forth. So through a week or two that we actually have gone through the complete inventory, and combining a periodic inventory with a perpetual inventory is probably the best means of a control process. The control environment is, again, back to the human resource policies and procedures, integrity, values, organizational structure, and the assignment of authority and responsibility. Risks, risk related to the availability of supplies and goods, stability of prices and labor rates, generation of a sufficient cash flow to pay for purchases, and one of the things that we want to consider is the obsolescence of inventory. One of the worst things that could happen is that we have a lot of inventory, it's there, it physically is there, but it's obsolete. So if it's obsolete, we need to make sure that that is coming off the books through some sort of valuation analysis of lower of cost to market, or some means of keeping the value of non-valuable merchandise off our books. Monitoring, this is part of management's duty, and then some sort of formal program to consider improvements in purchasing and production. This might be something that's taking place from internal auditing. When we talk about inventory, you notice how we actually mentioned this in our process, is we purchase the inventory, we receive the inventory, We store the inventory. This inventory is then issued to various departments. We have processing as well as shipping items. So the idea is that each of these elements create a control structure for the organization. In the purchasing function is purchase requisitions are completed by the department. Purchasing prepares the purchasing order. They're responsible for getting bids, for making sure that the quality and the pricing is appropriate. They're generally speaking the ones that establish vendor relations and actually input the vendor into the system. And they maintain this quality and the structure related to the purchasing. We don't want to have departments going out and ordering on their own. There is a reason why the purchasing function is critical. Receiving, when the items are received, the receiving clerk is inputting the items that have been received, quantity and the item numbers, and this then becomes important for our invoice, where the invoice coming from the vendor is matched with what's received and what was purchased. Once we get that three-way match, is then we're able to issue or approve for payment, and then it goes to cash disbursement. We're looking here from the inventory perspective. So we're storing inventory, we're counting it, we're receiving it, we're notifying and counting of its receipt, and we want to make sure that it's physically secure. Storage department issues goods to be requested, pre-numbered requisitions, production with a master production schedule. So when you look at production, we're talking about the direct materials, raw materials, and other products that are used in the production cycle. And this needs to be controlled so that these goods can then be charged to the appropriate product. Shipping only occurs after the sale is complete, and as we've talked about, is this needs to be managed, we need to have shipping documents. The shipping documents need to be matched to an actual sales order, an approved sales order, and you notice that this bill of lading proves that it was shipped through the common courier. Okay, so I think we've covered a lot of material. We've given a very good introduction to 3 accounting cycles. The first accounting cycle that we talked about is the cash cycle. We talked about accounts receivable and the purchasing cycle. And then finally, we spent some time talking about inventory as well as the purchasing cycle. So again, as we completed, or we talked about at the beginning of the lecture, is now we're starting to apply all the material that we have up to this point. And we're applying it from the perspective that we are considering the inherent risk, the control risk, and our substantive testing from the perspective of accounting processes or the processes within an organization. Otherwise, everybody have a wonderful evening,